Hi everyone. So today we are talking about IAS 2, which is inventories. What is inventory? Inventory is raw material plus working capital plus finished goods or any other purchases and supplies. That counts for inventory. IAS 2 talks about the valuation of inventory. It is considered as lower of cost versus net realizable value. What is net realizable value? There are three concepts to it. Net realizable value could be selling price minus cost related to selling price, or fair market value minus cost of sales. Sometimes net realizable value can also be calculated by selling price minus estimated costs of completion. If there is further cost involved in completing the inventory to bringing it to its condition for sale, then it is estimated cost of completion. So from selling price, if you deduct the estimated cost of completion and then deduct the estimated cost of sale, that is also NRV. Now, what is the measurement criteria? It is either through standard costing or retail method. What are the cost formulas used to measure inventory? First in, first out, FIFO method or weighted average method. Mind you, LIFO method for inventory costing has been discontinued. So there is no LIFO method to be applied now. It's either FIFO or weighted average. What are the direct costs of inventory? Direct cost of inventory is the raw material purchases plus labor plus any direct overhead costs. What are the direct purchases? Direct raw material value plus any octroi charges plus any duties or import duties and taxes plus any carriage inwards. So all direct costs which are involved in getting the item to its present condition and situation, that is called the direct cost of inventory. What is excluded from the direct cost? Any abnormal wastage, any storage cost, any administrative cost, or any marketing and distribution or selling cost. So all these costs are excluded, meaning not added to consider the direct cost of inventory. Once again, the direct cost of inventory, this is a very important concept under IAS 2. This is one of the critical matters to understand. Direct cost of inventory is raw material plus labor plus overhead. Raw material direct purchases plus octroi plus duties plus carriage inwards or any direct expenditures incurred in bringing the inventory to its current condition and situation. Abnormal wastage, storage costs, admin costs, selling and marketing distribution costs are excluded. These are expensed out in the profit and loss statement of the entity and not added in the inventory value to increase the asset side. It is not done. These costs are excluded. IAS 2 is not applicable in agricultural products, mineral products, brokerage or commodity deals. At a time when net realizable value is less than its cost, meaning the realizable value from selling that inventory, if it is lower than the cost of that inventory, which means that you are running in a loss, then you write down the inventory. There is a write down provision that is to be done in the profit and loss account. This will be the hit to your profit and loss statement. So NRV, at a time when it is lower than cost, you write down the inventories and specific disclosure requirements are needed in such cases. So this is a summary of IAS 2. Hope it is much more clearer now. Keep watching my channel. Stick to my channel. Please subscribe. Thank you.